Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and I'm Alex Mathew. Investors in mutual funds are a happy tribe. They've seen tremendous returns over the past year or so. In fact, in the small cap and the mid cap space, especially, the gains have been as much as 40 and 60%. We often talk about what to buy and when to buy it. But today I'd like to talk about what to do when you decide to sell. And specifically, how should you plan your taxes? And can you, in that same breath, set off your capital gains with losses that you've incurred in the past? What are the rules that govern that? And how should you account for all of that? And later on in the show, we'll also talk about loans that you can take against mutual fund units. What are the rules that govern such loans, and when should you consider taking them? Joining me on this program to give you answers to all of those questions is Arvind Rao, who is the founder of Arvind Rao and Associates, and also Nisreen Mamaji, who is the CEO of MoneyWorks CFP. So thank you so much to the both of you for joining in and for agreeing to do this conversation. Let me start with the first question, which is that there have been outsized gains over the last year. But of course, if you zoom out and you think about a portfolio that has grown over a period of time, this is par for the course because you have periods of underperformance and outperformance. Having said that, the question is, when do you decide to book a little bit of profit? Is there a possibility to make this formulaic? First, I'll come to you, Arvind. When do you decide to book profits?
Actually, normally we approach it in either of these two ways, which is one is you try to follow an asset allocation percentage. So whenever you find equities percentage moving above that, that's the time we would want to book profits so that the asset allocation stays at its level. Or second approach is where if you're following a milestone marker approach for a goal, in which case if the equity levels, which in most cases we find nowadays, has probably surpassed its budgeted values and you are probably a year or two ahead of where you were supposed to be. At that point in time also, we would want to book profits and move the additional gains to a more secured avenue.
Fair point. Nisreen, I'm guessing the answer is going to be similar from your side as well. But to those people that say, okay, my horizon is 20 years, is there an advantage of booking gains on an ongoing basis? There is, of course, that provision in the tax law that allows you to have 1 lakh of gains from equity that is not taxable in a year. So do you use that on an ongoing basis? Is that the primary advantage?
So typically, I think the answer lied in the query itself. If the investor is a long-term, investor with like a 20-year horizon, then we will not suggest that they will, book profits depending on market conditions, because it is not necessary then to undertake the, capital gains unless you have a loss that you want to write it off at that particular time. So if you're a long-term investor, unless you're meeting a goal in that particular year and you want to make a redemption based on your goal, having reached the milestone or you have reached a goal, then of course it's absolutely great for you to redeem. But if you're a long-term investor, my advice would be typically to stay invested and not keep on, transacting or churning your portfolio depending on market conditions, because there will always be a tax implication, which, beyond 100,000 rupees, you will be liable to tax. If you don't have a capital loss to set this off against, then, you will be charged at the rate of 15.4%. So longer term investor, just stick to your knitting, stick to the goal horizon and continue, investing, continue your SIPs, continue your lump sum investments, and just stay focused on the goal itself. That would, in short, be my advice.
Arvind, I want your view on this as well, because I've been told that it's a good idea to utilize this provision, especially if you're talking about, you would need to have a sizable portfolio and sizable gains to book 1 lakh of profits in equity in any given year, right? So, yes. So it's not every year that you make gains like that. Having said that, is there a case to be made to prune and to use this provision on an ongoing basis? I would think that over a longer period of time, say going into 5, 7, 8 years, the incidence of tax at the end of that period would be significantly lower if you utilize this provision over a period of time?
I think the best way to answer this is that one is what stays true in theory and what actually transpires in practice. So in theory, when you put it this way, the way Alex put it down, yes, it does make sense to utilize the 1 lakh exemption. But let's also keep in mind that there are one, transaction costs. Number two, there is an effort that would be required to book profits and then decide what to do of it. So mostly we meet people who generally seek to be in long-term investments for one major reason being that whenever they get money, there's a decision that is required on their part as to where do they park this money. And which is why, in one of these queries, I was mentioning that mutual funds themselves are structured as tax sheltered vehicles. And these fund managers, given the ups and downs in the markets, are also booking profits for investors within the fund. So in practice, Alex, I don't agree that 1 lakh, just to utilize the threshold of 1 lakh, it makes sense to keep booking profits. I think in the longer term, those gains are more than taken care. The tax benefits are more than taken care of by the gains that you will make.
Okay, so I'm glad that I'm getting a consensus view from both the experts on this panel, because that is essentially what Nisreen was pointing out, and I just wanted to elucidate that point even further. And by the way, in case you didn't know, and I didn't introduce Arvind as such, but his firm does take care of taxes on an ongoing basis. So I think he's fairly familiar with what I'm talking about as well. But having said that, let's talk about making this formulaic, because a lot of times the point that you just made, Arvind, it's very hard, right? If you book profits, so suppose you're seeing outsized gains in any one of your equity schemes, even if you do book that gain, you're sitting on a significant sum of money and you don't necessarily know what to do with it, and money spent on the sidelines is not doing anything, right? So Nisreen, I'll come to you on this next one. You said that there is the ability to create a formulaic approach, but that's easier said than done. How do you lay out that formula that is very easy to do?
So, the formula actually is much easier if you go in for a dynamic asset allocation fund, where the fund manager himself is going to rebalance on a regular basis, rather than the investor attempting to do this periodically. Because then you will have to follow the market timing, you'll have to look at the tax implications, and you'll have to keep detailed notes of the buy date, the sell date. So all this for a regular investor would become very difficult, to keep on tracking this on a regular basis. But if you go in for a dynamic asset allocation fund, where there is a fixed amount which will be parked in equity, a fixed amount in bonds, and perhaps you'll also have commodities and gold and international equities. So if you have a range of these products in a multi-asset fund, for example, then the rebalancing will be done regularly, keeping in mind the market conditions, keeping in mind whether the bonds are the better investment right now, whether we are sitting on the highs of the equity markets, whether we are sitting at the lowest yields in the bond markets. So for a layman investor or for a retail investor, I wouldn't really recommend going in for any kind of formula rebalancing. It's best left to the fund manager to keep doing this on a regular basis. Having said that, the medium-term goals could typically be parked in a dynamic asset allocation fund, which is the period between, say, 3 to 5 years. Between 1 to 3 years, you can go in for, a hybrid fund which has more of bonds and arbitrage rather than, 100% equity, because if you need that in the shorter period of time, 1 to 3 years, then that amount may not be easily liquid. So any amount which is invested for more than 5 years can go for a 100% equity fund where you don't have to do the rebalancing. So it's a good idea to have this conversation with your professional advisor and, to make buckets of instruments depending on your goals. And therefore, the middle one, which is the midterm goals, could possibly be parked in the dynamic asset allocation fund, and you need not keep on rebalancing depending on market conditions.
Okay, fair enough. But let me add a little bit of a hypothesis or hypothetical scenario here, because I think a lot of our viewers also at this point, having done this for a little while, understand what they're doing. and they have an approach that is a little more nuanced than what you're suggesting. Nothing to suggest that what you've said is not the primary focus of a lot of investors. But assume here, Arvind, that you have an individual that is got an asset allocation strategy that they're managing themselves. They've got a certain amount of money that they've got in their core portfolio, in their equity portfolio, which is perhaps in an index fund. And they've got a satellite approach and they've invested in a mid-cap and a small-cap fund. There has been a bit of a shift in that asset allocation strategy. They have about, say, 70% in equity, 30% in fixed income, and that has gotten skewed. This is a prime opportunity for them to rebalance, therefore. What do they need to bear in mind on booking those capital gains in equity from a tax perspective, right? Because you are doing that and you are switching automatically to your existing fixed income funds, but there is an incidence of capital gains. You have to pay advance tax if it is earlier in the year, right? So what are the key points to remember when you are doing that rebalancing?
I think the first thing that we need to, all our investors here need to know is that the income tax law is quite fair here, because it says that you have to pay taxes only on the net profits, meaning whatever profits you make during the year, you are allowed to set off any losses that you make, and only on the net amount is where you are liable to pay any kind of taxes. So if you are in a situation the way Alex described it, and you have incurred some profits which you are booking now and accruing some capital gains, my next step would be that also look into your portfolio. There could be certain funds or other investments that are giving you losses, which you have been carrying on for some time, not really in a mood to book those losses. So if there are gains, the suggestion here is to look at losses, book the losses, offset this, because this will help you to reduce some of the tax outgo that you are liable to pay on the profits. And whatever is the remaining profits that are left, yes, you are required to extrapolate what would be the taxes on the same. There are advanced tax installments that are available every quarter. See in which quarter you have booked these gains and accordingly plan the tax installments accordingly for the balance quarters that are left.
Could you lay that out as well? If you assume you book in the first quarter, what is the periodicity and amount that you have to pay in advance tax?
In which case there are 4 installments, which is June, September, December and March. June starts with 15% of the total liability, followed by 45% in September. In December, you are liable to pay up to 75%. And finally, by the 15th of March, you are supposed to finish full 100% of the liability by way of advance tax.
Just as a follow-up to that, and we'll talk about booking losses and setting that off in the next segment, but just as a follow-up to that advance tax statement that you've just made, assume that you've booked it in the second quarter. Does that still mean that by December you have to pay 75% of the tax due?
That's right. And one more thing, just to top up this follow-up question of yours, Alex, is that for capital gains, the good part here is that advance taxes become liable from the quarter in which you have incurred them. Unlike your normal business or interest income, where even if you happen to pay advance tax in the end, you end up paying some interest for non-payment of advance tax in the previous quarters. So with capital gains, what happens is the liability to for payment of advance tax triggers only from those quarters in which those gains have happened.
Got it. All right. So we've got more to talk about, but we have to slip into a very quick break. Viewers, do stay tuned. We'll be back before you know it. Welcome back. We're talking about how to deal with capital gains. And in fact, we've already talked about how you can set off your capital losses against the gains that the other way around. Apologies. Set off your capital gains against the losses that you've made, right? So now that you know that you can do that, the question is, what are the rules that you need to bear in mind? Arvind, you already described how this should be done, but there are a certain number of years in which you can carry this forward too. And what are the rules that govern short-term and long-term capital losses?
So as regards the number of years, in case you have not been able to offset it within that year, you are allowed to carry forward these losses for the next 8 years. So anytime during this period, it can be used to offset. And the other rule which we need to keep in mind is that you can offset your short-term losses against short-term gains as well as long-term gains. But when it comes to long-term losses, those can be offset only against long-term gains. These are the broad two rules.
Fantastic. All right. So let's jump straight into the last conversation or the last topic for the day, which has to do with loans against mutual fund units. It's not often that these are spoken about because, and I'm sure that a lot of our viewers, Nisreen, have gotten calls saying, hey, do you need a personal finance or personal loan, right? In the last year in particular. In fact, I've been getting calls saying, do you need a top up on a car loan that you have? And that's the latest that I'm getting. But having said that, when do you consider taking these loans and what should you bear in mind?
So basically, the mutual funds allow investors to borrow money by pledging their mutual fund units as collateral. So after approval, the investors pledge a specific quantity of the mutual fund units, and the loan amount is determined as a percentage of that. So you're eligible for a certain amount. Now, if you have equity mutual funds, you will be eligible for about 45 to 50% as a loan. For debt mutual funds, the rate is about higher. You'll be eligible for at least 75 to 80%. And for hybrid mutual funds, it's around 60 to 70%. So that's the eligibility criteria. Now, your query was that, when do people actually consider going in for this kind of a loan? So we have been getting, a lot of calls because since the markets have moved up and people have seen that there is a lot of, capital gains and they want to quickly optimize the situation. So one of the reasons is obviously if you have a short-term liquidity crisis. So instead of, redeeming the units because you feel there's still some steam left in the market and your units will probably be valued higher at a later date, you can then take a loan against these mutual funds and, manage your short-term liquidity. Also, you can have unexpected expenses or, like a medical emergency where suddenly you need, larger amount of resources. There again, you can look at a loan against security. Then you'll have a situation where, you might have another investment opportunity because you see that there is a lot of investment, steam in the market and you want to put in more funds, but you don't have the liquidity to do that. You can take a loan and then pump in that amount, as an investment opportunity. So these are some of the reasons that, typically people also, go in for loan against mutual funds. And they also can do it, if they want to pay off their debt. So, for example, if you have an EMI for a home or a car, and you see that there is some, position left where you can repay your loans, that's also a very good reason for you to take a loan against mutual fund.
Okay. So that's fair. And you've laid out the possible reasons why you would take this. But as far as I know, not every bank gives this as an option. So I would think that the larger banks have this as an option, or am I wrong in thinking that? And second, what are the kind of rates that you would normally get on something like this? How are they comparable to an unsecured loan?
So typically the rates are between 9 to 10.5%. So ICICI Bank offers loan against security, HDFC Bank offers loan against mutual funds, Kotak Bank also offers, Bajaj Finserv also offers. So there are non-banking financial companies also which will go in for loan against securities. So the rates are between 9 to 10.5% either for debt or for equity mutual funds. So one has to consider whether you are going to be earning more because some of these units obviously once you have pledged it and they are under lien, then you cannot use it for any short-term redemption. So you have to then make a comparison between the rates that you're paying versus the rates that you're earning actually on the mutual fund itself, and whether you would like to redeem that if it's earning you less, or the other way around, whether it is better to take a loan and then repay some of the debt that you are holding, or for your short-term liquidity needs. So there has to be a comparison between what you're earning and what you will be paying for that loan, and whether it's worth it at all to do it.
In fact, that would have been my question, or that is in fact my question. 9 to 10.5%,
Yes.
and assuming that it's you have to do better than what 10-11% on a CAGR basis to make that a lucrative proposition. Arvind, what should you bear in mind? Because if you have a drop in the equity markets, again, that's going to be a bit of a pinch for you, right? Because the bank will come and call you and say, hey, your collateral is not enough. So should you consider this as an option at all?
You could, and normally what we tell people here is that if you have a certain portfolio and there is a requirement, obviously the whole portfolio is not pledged to raise this kind of money. So like you rightly said, because the collateral value may come down in case of a correction in the market. So it is always important to keep that 15 to 20% of your funds available as a cushion, which you can then top up to the loan security and continue with the loan instead of having to scamper around and try to raise that extra money to repay it.
Okay, fair point. All right, so I think we've had a holistic conversation on both capital gains and losses as well as on loans against mutual funds. Thank you so much to the both of you, Nisreen as well as Arvind, for joining in and for speaking to us on the Mutual Fund Show. All right, and that brings us to the end of this particular edition of the Mutual Fund Show. If you've got questions for us, you see that number on your screen. Don't forget to write in to us and let us know what you think. And also, specific questions, do share them with us and we'll get them answered on the show. Do stay tuned, lots more coming up on this program, or rather over the course of the day. And this is NDTV Profit.
In a few days from now, the Union Finance Minister Nirmala Sitharaman will be presenting her 6th Union Budget. Now, this budget is a little different from the ones before. It'll be an interim budget or a vote on account budget. What that exactly means is that this will look at expenditures or allocating funds till the general elections from the beginning of the financial year. Now, after the elections, the government that comes into power will be presenting a full-fledged budget. And in this particular show, that's exactly what we'll be focusing on, these particular expenditures, be it the subsidies, be it the ongoing projects, be it salaries, wages, and other revenue expenditure. We will be looking at, with experts, on what exactly are the expenditures that exist, the expenditures that have been committed, and the ones to look forward to. Stay tuned with us. Today, I'm joined by 3 very special guests to infuse this conversation with their math and their micro sense and help us understand the role of these elements in the fiscal that is yet to come. Firstly, I want to introduce Aditi Nair, Chief Economist at ICRA Limited. We also have with us Yuvika Singhal, economist at Quant Eco Research, and I also have with me Dr. Lekha Chakrabarti, professor at the National Institute of Public Finance and Policy. She's also a member of the Board of Management at the International Institute of Public Finance. Very many thanks for joining us today. Thank you so much for coming. Firstly, I want to start with you, Aditi. As we wind up to the end of FY24, what we're seeing is that in December, the supplementary demand for grants was not a big amount. It was matched by a good amount of savings, in fact.